Good evening and welcome to tonight's live webinar where we look at the ASX investment opportunities in review for the 1st of June 2020. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service. It includes access to our model portfolios, which cover the ASX 20, 50 and 100. We also have a model portfolio for the US S&P 100. Within the broking account, we also have access to our ASX and US high conviction portfolios, along with our new ETF iShare model. In addition to the model portfolios, we operate an independent portfolio where we work in partnership with you to execute ideas that we jointly agree on. And within the portfolio, we can utilize derivatives to enhance portfolio returns. If you're interested in opening an Investor Signals account, please contact me on 1300 614 002. Up on screens the performance of the Investor Signals model portfolio as of the end of April. We'll have the May data out in next week's recording. The Australian equities portfolio has a 5-year average of 12.29% and year to date down 1%. The US S&P 100 has almost a 12% average, 11.95% average, and it's down 7.8% again at the end of April. So we'd expect those numbers to be up a little bit further with the strong equity markets in May. The Investor Signals website, please visit it. There's 3 services that we offer. The research, which is a combination of our member-only technology and our recommendations around ASX and US buy-sell ideas, and you can subscribe to that for $1,320 for the year, and that'll be the technology that I'll be utilizing tonight. Our broking account service, as I discussed in the previous slide, that's where we work in partnership with you to manage a broking account, execute orders that match the ideas being presented on the blog and within our recordings and within our model portfolios, or we have a managed fund. So visit the website and we can assist you with any of those services. The technology or subscription to the Investor Signals member area, $1,320 for a year, and please either email or contact the office if you'd like to discuss that further. If you haven't already set up a free trial, if you visit the website, you can get a free trial to the technology for 30 days, and we can walk you through the technology and show you how to use it. Up on screens the earnings of the S&P 500, and we've looked at this a number of times over recent weeks, but in particular what I wanted to focus on is this number here, the 2020 numbers. We start to get a bit more of a sense as to where consensus expectations are, and albeit the market's not focusing on this, the assumption is that by 2022 we get back to average earnings at about 160. But the more I read, I start to have a view that the 2020 earnings is going to be around $120. So I always thought maybe 130, but if we assume it comes in at around that 120, 130 range, if we go back to where the S&P was trading last time, was at around that 2,000 points approximately when earnings. So let's say it's not 120, maybe it's somewhere near 130. It certainly builds a case that fair value for the S&P 500 is at lower levels. Now, if the market can have some level of certainty that 2022 earnings are going to accelerate, or even 21 earnings will accelerate, but it's a big jump from 120 back up to this sort of 170 or 180 level. I don't think 2021 is going to be 180, but the market could be satisfied with 2020 earnings being around $120 of earnings per share. 2021 earnings maybe growing back to 150, and then 22 earnings back to that sort of 160 level, which is where we started from, which supports the valuation today of 3,000 points on the S&P. But no matter which way you cut it, a lot of good news is priced in the US equities where they are at the moment. If you think about it, if we consider these the good times, we had 2 years where the market was unable to grow earnings, and to think that we're going to come out of this with earnings accelerating back and surpassing these levels, I think seems like a stretch. So, logic would suggest that at some point this year, the market's resolve for this level of optimism is going to be tested, and it seems plausible that that comes in that first week of the earnings falling in July. So we'll focus on stocks and how to structure a portfolio, where we see safe allocations and where we see risks in the market as I toggle through tonight's top 100. Up on screens, the graph again that we've looked at, just looking at prior recessions, and are we in a period where the market can simply re-accelerate, create new highs, or are we in a period where there's another leg down to the selling in the market, and we get into some normal territory of maybe 9 months being a short recession? And obviously, there's examples where other recessions have dragged out 2 or 3 years. My base case is no, it's not a long dragged out recession over 2 or 3 years, but I'd be surprised if we don't have another leg down, not necessarily taking out the prior low, but you'd expect to see some valuation adjustment come into play given those lower earnings in the S&P. One area of strength in the Australian market that's helping to support the index is iron ore prices. Iron ore is now pushing back up towards $100 a tonne. So if you just look at the trend over the last 3 or 4 years in iron ore, it's traded from around 50 pushing back up to 100. Not looking for it to get back up to these prior peaks, but it appears that it could sort of at least find support here at around this $90 level and continue to push a little bit higher, and partly that's obviously supply issues with some of the mining in Brazil, South America there, bringing supply off the market. Up on screens, a graph of the Nasdaq. Something that we've been focusing on is the shift from algorithm buy signals to algo sell signals. The index is still pushing up against the top end of that resistance of where that price gap is, and we just want to watch this just to see if at some point we start to get more of a rollover pattern there in the Nasdaq. In our local market, if we look at the XJO, we haven't had that same percentage rebound that we've seen in the US. The strong resources is helping the overall index, but without the banks contributing, we don't see the Aussie market sort of recapturing in the same magnitude that Nasdaq has as recapturing these highs, and therefore I've sort of flagged that as a probable resistance channel there. But given where the Nasdaq is at, it seems more than likely that the Aussie market will find resistance at the lower bound of that level there. First thing tonight, what I wanted to do is come in here and we're going to toggle through the 100 stocks, and then we'll come back and revisit the postings on the blog. So we're going into the watch list, we're selecting ASX 100, we get the percentage gains to the top, and we organize it in buy signals. So as I toggle through these are all stocks that are under buy signals, and then we get to a point where they switch from buy signals into sells. So and we'll cover that as I go through them. So starting with Fortescue, beneficiary of strong iron ore prices. Our preference remains BHP Rio, but obviously Fortescue's done extremely well. It's a holding that's in our algo model portfolio, and when it switched from sell conditions here into buy conditions was when it was added to the model, and it's continued to perform well. Flight Centre, recovery underway here, which is encouraging, but very hard to really get any visibility on what how quickly demand returns, what earnings look like, and the damage that's been caused to this business. But for clients that are willing to take on a little more risk, the risk reward or recovery opportunity there at Flight Centre could be attractive. Rio, beneficiary of strong iron ore prices, so this has been one of our preferences as a way to play growth in the Aussie market, which has been BHP and Rio. Continue to see this pushing up and maybe trading up against that $100 level under those strong iron ore prices. Beach Petroleum, not our preferred energy play. It's been Origin, albeit that switched to sell conditions, but Santos continues to remain under buy. BHP, so as with Rio, pushing up against the top end of that sort of valuation bound, but you could see BHP, trade up towards that $37 level as we see iron ore maintain these strong levels. Now CSL, I add this one to your watch list. I'll revisit this as we toggle through the blog postings. But CSL with a correction from 340 down to 275, I think there's a buying opportunity there. We expect to see some weakness in CSL's earnings in the June quarter, mainly a combination of elective surgeries not taking place and blood collection centres unable to operate during the quarter, because of obviously social distancing and the pandemic globally. Star Entertainment, so it's had a good recovery, but again, hard to get visibility on what VIP earnings look like and how quickly international travel returns, and I think that crimps the earnings. So I'd be surprised if the stock can just keep pushing higher, but it is a buy on the dip opportunity in the second half of this year. AMP, under buy conditions, not really stock we're too active in. Newcrest, I've been promoting this on the blog. The pullback under $30 is a buying opportunity. We think Newcrest can push back up to $33. All the fundamentals are in place there for gold to remain strong. Santos, getting a little expensive for where oil is at $35 a barrel. It's still a big hit to earnings from sort of $50 back down to $30 a barrel for oil. Santos has learnt from prior adjustments in energy prices. They can shift to a fairly efficient operation quite quickly. But it's just hard to see that again that the stock just keeps pushing higher. You would think that oil prices around this sort of $35 is about where it sits for a while. Maybe in 3 to 6 months' time we could see oil prices back up to $50 a barrel. But you would suspect that we're getting back to near resistance levels for the time being. Northern Star, we like this within the gold space. Obviously Newcrest is our preferred, but Northern Star, we see the whole gold complex continuing to push higher at the moment. JB Hi-Fi, not doing anything there. It is in the model portfolio. It switched from sell conditions into buy conditions there at around $22, so it is a holding in the ASX 100 model. Cleanaway, we continue to like this business at $2. It probably captures the upside for the time being, but any opportunity to buy into this on the dip into the back half of this year. But the story for Cleanaway over the next 12 to 24 months, I think we could see the share price trading up at around $2.40. So there's good upside potential there with dividend yield. Illumina looks cheap down here at $150, and I think that's a stock you could think about with running stop losses. Dexus, not doing there at the moment. Ansell, getting too expensive for us to continue chasing that, but it is under buy condition, is a holding in the model portfolio. Orica, there's some value here, so may mark this one down at around $17. I think there's a upside opportunity there to participate in. Bendigo, not doing there at present. Sydney Airports, we're going to see a cut to the dividend this year, both in June and the December dividend, but there is an opportunity here in the back half of this year where sentiment's going to improve around Sydney Airports as a business. So it's one I think to start to have a think about over the coming months. Westpac, so the Aussie banks, it's still reason to be cautious over the next 2 to 3 months. We did see a rotation last week out of technology stocks into banks and industrials, and at that point in time, and this I'm predominantly talking about in the US here, and it did then feed through to a rally in the Australian banks. Now, there was a lot of short positions in the Aussie banks. Part of that rally was short covering, and then obviously investors getting on the long side of the trade as well. There was little follow through on that trade in the US, is the point that I'm wanting to make here. So on Friday night, for example, Citigroup closed down 6%, and a lot of the US financials were down anywhere from that 4 to 6% range. That's then resulted in the weakness that you've seen in the Aussie banks over the last couple of sessions. It's too early, I think, to say whether the worst is factored into these banking stocks. My sense is it's probably not, and I suspect that we've got further write-downs that the banking sector will suffer over the coming months. So we're still a little bit cautious around the banks, and likewise there with NAB. Coles, we see Coles and Woolworths we see as a more defensive opportunity. Coles has corrected from $18 down to $15. Buy the stock, let it move up to around $16. Sell covered calls. Afterpay getting expensive, but I do think we'll see an algorithm buy signal on this in the back half of this year, and if we see a pullback to around that $30 level, it may be a buying opportunity there for Afterpay. Cochlear we like. I've spoken in detail about them shoring up the balance sheet with a capital raising at 140. Global business, good underlying earnings growth, is a little on the expensive side, but Cochlear, ResMed, Sonic Healthcare, CSL, all stocks worth continuing to buy on the dip. So at the moment, the one that really stands out is the sell-off in CSL. CBA, same applies there across all the bank stocks, that we still just remain a little bit cautious as to what the next 2 to 3 months have installed for the banks. ResMed, I'd like to pick this up at around $22. So we'll just continue to monitor this at the moment, and I'll update you on the blog if we see that pull back a little bit further. Sonic Healthcare, we've been long this stock in the high conviction portfolio. We've trimmed the position size. If we see a pullback to around $26, I'd be aggressive on the long side there of Sonic Healthcare. It'll continue to recover into the latter part of this year and next year. Woolworths at around $35. Buy it, look for a move slightly higher, and then sell covered calls. You're getting 10% cash flow from the dividend and the franking credits. ASX is in our high conviction portfolio. We're starting to trim that position size. We think volumes are starting to taper off a little bit. We're looking for a buy on the dip in the coming months in ASX. We'd expect to see it back down maybe around that $80 level. Ramsay Healthcare, not doing there at the moment. We think that's near full value. Coca-Cola, hard to get excited about the growth prospects here, which are, we're likely to see earnings fall this year and maybe the same next year. So fair values maybe around that $8 to $9 range. The downside risks seem relatively low, so you can certainly buy the stock and sell covered calls and strip out the dividend and the option income. APA we think's up against resistance there at the moment. QBE Insurance, still cautious on QBE. We think their exposure in the US is a risk to the company. Insurance Australia Group is a little more attractive. And buying this on a dip, I think anywhere below $6, you could start to think about adding Insurance Australia to the portfolio, and it may be that it pulls back down around this 570 in a soft market, but would certainly be comfortable buying that now. Mirvac, not doing there at present. NIB Holdings struggle with the health insurers. TPG would be a name that we were buyers of at below $7 at around this $8 level. It's near full value. And now what's happened is we've switched from buy conditions into these sell conditions. So we've seen a large increase in the number of algo sell signals in the market, and it doesn't mean that all of them are shorting opportunities. It just means that they've gone from buy conditions into sell conditions. So as I move through these, I'll just focus on the ones that are maybe more, stand out more as a shorting opportunity. So Iluka Resources running into resistance there, hasn't rolled over yet. Evolution Mining, we're not shorting gold. Origin, just flagged there that there's a price gap in Origin back up to around 660. I'd expect that sort of completes that resistance channel there for Origin. Aristocrat, still of the view that around that $27 for the moment is near resistance. CIMIC Group's under sell conditions, but I actually like the fundamentals there. I think CIMIC actually starts to recover in the second half of this year, and it's an opportunity. Worley's cautious here, and if we're looking for short opportunities in the market, I think Worley's under the fits that bill. REA Group, these technology stocks are now getting expensive, and you're paying a premium for growth in the Aussie market. What we're looking for is a sell-off off the back of those June earnings results coming through, and we'd look to buy the dip in REA, Seek, Aristocrat, car sales, and some of these other faster growth names that we think have just maybe got a little bit ahead of where earnings are at the moment. Oz Minerals, we really like the story here with Oz Minerals. The bounce from $6 back to sort of roughly $10 looks like it could be sort of nearing a resistance level. But again, if we saw an opportunity to pick this up on a sell-off over the coming months, we'd look to re-enter Oz Minerals. South 32 not doing there at the moment. Oil Search not doing there. BlueScope, resistance may be at around $12, but we'll review this a lot closer after the June earnings results. James Hardie, we were bullish on this, but we think that's back up against resistance. So James Hardie, Boral and CIMIC all look attractive to us. Out of those three at the moment, probably CIMIC's the one that we still see further upside. Boral and James Hardie look like they've captured a lot of that sort of value gap that was there. Xero up against resistance, so we're not doing it there at the moment. Lendlease has just switched into sell conditions. Now the story here fundamentally with Lendlease is quite attractive long term, but short term a number of things have to go right. They still need to divest the engineering business, and we're still not really entirely sure what the impact of sort of this whole COVID period is going to have on the earnings for Lendlease over the next 12 to 24 months. Nine Entertainment under resistance there. Computershare up around $13 to $14. We sort of share the view with the technical indicators there that it's near resistance. Woodside Petroleum, preference Santos out of the energy space, so that continues to exist. Caltex, so we've liked this as a recovery play coming, with people returning back to work, but at around $27, $28, that appears full value at the moment. Cube back up against resistance. Treasury really under that downward pressure there. Tabcorp, I flagged on the blog that we still have some concerns there around the earnings impact over 2020 and whether the share price can really sort of push higher in the face of that. ANZ within the banking stocks, we're happy to view that as a shorting opportunity. AZJ at around that 480 given 100% dividend payout ratio, that looks full value. Amcor back up at 15, I think that's starting to look a little bit expensive. Car sales, great business. So we're on the long side of this trade, but back up at around $16, $17, starting to look a bit expensive. Link Administration not doing there at the moment. Crown around $10, looks expensive. Wesfarmers at around $41. We're a bit cautious there on Wesfarmers. Transurban's recaptured full value at 15. Seek again $21. What we'd like to see is weakness in the broader market and the more substantial correction in these technology names over the coming months and an opportunity to buy into them at lower levels. Qantas not doing there at the moment. Macquarie. So this has been one of our financial services stocks that we've been on the long side of. But again, without sort of further visibility on the earnings trends coming into this COVID period were weak for Macquarie, and there's some uncertainty as to what the impact really has been on the company. Whatever impact that is, we don't think it's a long-term issue for Macquarie. And any correction from 110 back down to say $90 or thereabouts, we'd see that as a strong buying opportunity again for Macquarie. AGL not doing there at the moment. Altium, concerned that that's getting expensive. Magellan, obviously, if we're a bit worried about overvaluation in the US stock market, the same, that flows through to Magellan. GPT, Office Property Trust. So the property play, Goodman's been our preferred exposure, but at $15 that looks expensive. And just skipping through a couple of these. Brambles, we like Brambles, 5% earnings growth in a market where not many companies have provided earnings guidance. But again, at around $11, $12, probably full value. So either sell covered calls to drive extra income or just be a little bit patient. And if we could pick it up on a move back around that 10.50, we'd see that as a good buying opportunity. Suncorp within the banking space, short Suncorp, short ANZ, still makes sense to us in this environment. Downer EDI, preference CIMIC over Downer. Telstra, so this has switched to sell conditions, which has been interesting. Telstra's doesn't appear that they're going to have any problem covering their 16 cents of dividend. A combination of underlying low levels of underlying earnings growth and the contribution payments from NBN over the next 18 months pretty much means that the probability of that dividend being cut is pretty slim. The growth in the underlying business is likely to be low. The event that's going to unlock value for shareholders is the spin-off of the infrastructure side of the business. So even though it's switched to sell conditions, so if you're a bit cautious, you could take that as an opportunity. If you've just traded the stock, we're buyers of it at $3, so getting out at $3.30 delivered a reasonable return. We could take another look at it if we see the stock back down at around $3. But I think by the end of this year, I'd be very surprised if Telstra was not higher than where it is today. Atlas not doing anything there. Spark Infrastructure, Univale. So this is the old Westfield shopping centre business that was taken over by the French conglomerate. It's now a global premium sort of shopping mall owner. They've gradually been running that same Westfield strategy where they've been divesting regional shopping centres, but again, to get visibility around what this whole impact means to retail mall owners. But the upside potential in here could be very high if if they survive the current issues facing the sector. But resistance was up here at around $12. It's been under sell conditions and it's obviously moved lower since then. Incitec Pivot under sell conditions, so moving lower, but they raised $600 million at around this. I think it might have been around about $1.60 a share from memory. We think that underpins the downside risk. The balance sheet's in good shape. Medibank resistance there at around $3. WiseTech resistance at around $20. Stockland resistance at $3.50. Bank of Queensland cautious on the regionals at the moment. ALS resistance at $7. Challenger. So again, moving through some of these quickly, but just pointing out the number of stocks that are now under sell conditions versus the limited number of companies that we're focusing on the buy side. So now we've switched back to buy signals. What I want to do to finish tonight, just to make sure that you've had the opportunity to make a note of the stocks we're most focused on. I'm going to come down the watch list here into recent blog posts for the ASX. Again, I'll get the percentage gains to the top. I'll make sure we're starting with the buy signals. And these are, so each day, if you're not familiar with it, we post 2 or 3 stocks on the blog that is the focus of the analysis. And it's not necessarily 2 or 3 stocks just for the sake of it. So we're sometimes revisiting the same ideas that we've had on the blog from previous days, or just the timing to take advantage of the same opportunities is relevant. So we've been bullish on Rio. It switched from sell conditions to buy conditions back in middle 2019. We have further buy signals down here at around $70, pushing up to around that $100. We like Rio. There's maybe a little more left in the tank there. Same with BHP, maybe a little more from 35 to 37. But with iron ore, likely to run into resistance around that 100 level, or at least find support there and track sideways. I'm not sure that BHP and Rio can just keep pushing higher, especially if we get a backdrop where that US equity valuations start to correct a little bit. CSL, ideally what we'd like to see here is another test of that 275 support, and maybe just see the price spike down around 265, and we'd look to buy call options in CSL as leveraged exposure to the upside. Star Entertainment, I covered that earlier. Newcrest we think that can push to 33. Northern Star we like. Newcrest is the preference though. Cleanaway over the next year or two, that trade up towards that $2.40 level. Illumina looks cheap at 150. Give that some thought. Run stop losses. Orica at 17 we like. Coles at $15 seems a defensive position in portfolios. Cochlear are holding that higher low around 180 and pushing a little bit higher, maybe stop losses below 180. NRW, so this is a contracting company that delivered good results relative to market consensus, and we've seen the stock rally from sort of $1.25 up to $1.90, but the earnings growth outlook there looks attractive. CBA, cautious on the banks at the moment. ResMed, ideally below $22, and I'll continue to update you on the blog as these opportunities come, from a timing standpoint, evolve further. So InvoCare we kind of missed the opportunity here. This is an example again where a company's raised capital, short up the balance sheet, which just takes away a little bit of investor risk. And as the global or Australian economy slowly returns to some level of normality, InvoCare's business will benefit from that. So maybe at around $12, if we saw it pull back to a 10.50 thereabouts, it'd give us another opportunity to take a closer look at InvoCare. Sonic Healthcare, expensive up here. We want to try to buy into that at around $26 on a pullback. Woolworths, comfortable buying that at the moment. Insurance Australia at around $5.75 would be a good entry level. TPG, we'd want to see a pullback back below $7.50 to participate in that again. Aristocrat up against resistance there. CIMIC, I've spoken in detail about that. James Hardie looking a bit expensive at the moment. Computershare back up against resistance. Keltex, which is now Ampol. I always pause on this because of the takeover offer. They're at $34, so there's the potential that offer in a normalised market is resubmitted. At the moment it's been withdrawn, but the company making the takeover never found anything material in their due diligence that would prevent them with proceeding with that $34 takeover. But given that there are earnings impact to Ampol for 2020, it's hard to sort of form a view that the stock's suddenly worth that takeover premium if there's no certainty around that offer being resubmitted. So $26 is about fair value in normal trading circumstances for Keltex. Tabcorp, bit cautious there on underlying earnings trends. ANZ, if we're looking for shorts within the banks, it's ANZ and Suncorp. Crown looks a bit expensive at 10. Keltex we covered. Macquarie, we like this, but maybe at 110 to 120, starting to get back into that sort of full value range. Telstra I've already covered in detail, as with Incitec, and there we are back at the beginning. So thank you for listening in to tonight's recording, and as I mentioned earlier, if you'd like to jump onto our website and sign